Hi, this is Rob Carrig with Carrig Wealth Advisors. Thank you for joining me for a brief November 2022 market update. This will be a little bit different from some of the videos I've posted in the past. I'm not going to show any slides today. We've had a little bit of difficulty of using the slides moving forward. We're working on that. The other thing you're going to hear me say a lot is according to. I've been told I need to cite my sources whenever I talk about any sort of market data. So to say this has been a rough start to the year would be a bit of an understatement. According to BlackRock, the bond market for the first 3 quarters of this year was down 14.6%. That is the Bloomberg U.S. Aggregate Bond Total Return Index. According to BlackRock, that is the worst start to the year since 1926 for bonds. For stocks, the S&P 500 was down 23.9% for the first 9 months of the year. That was the 4th worst start since 1926. Investors that use an ESG portfolio, environment, social, and governance, generally had an even more challenging period for returns in their portfolio. One of the things that has come as a result of the Federal Reserve raising interest rates is that money markets, CDs, treasuries are yielding somewhere in the neighborhood of 3 to 4%, according to Raymond James. Money markets are yielding a little over 3% right now with daily liquidity. In my opinion, that will likely go as high as 4% as the Fed continues to raise interest rates. Many investors are looking at these returns, 3 to 4%, and for, in some cases, a portion of their portfolio, considering reallocating some money out of stocks and out of bonds into these 3 to 4% buckets. We are doing that for some of our clients when we meet with them. The reason why we're generally sticking with the long-term plan is that the recoveries historically from markets like this have been better than that 3 to 4% per year. That same data from BlackRock, on average, if you look at the 10 worst 9-month periods for the bond market and then looked at the next 12 months, on average, it was a positive 9.3% for 1 year. For stocks, if you look at the 10 worst starts to the year and then 1 year later, on average, it was a positive 9.9%. So I believe that investors that stick with it will do better than those that are putting their money at 3 and 4% based on what we've seen historically. Should you be making moves in your portfolio? Everyone is a little bit different there, and that we are handling on a one-on-one basis. Please get in touch if you'd like to discuss. As always, my email is rob.carrig@stewardpartners.com. Thank you for joining us.